Let's talk a little bit about short-term rentals and how this
Yeah,
workaround is. I guess first we need to talk about RE Pro status. Let me share this screen here. You can give us a little bit of info on what it means to be a real estate professional.
sure. So the the big opportunity with real estate professional is you get to deduct real estate losses against your ordinary income. So we talked about this endodontist who goes to work and works 100 hours a week or whatever, and their spouse, if they were making, $1 million a year, but they're working 80 hours a week and that's their full-time job, and they handed you, Nick Huber, $100,000 to go buy storage facilities and got a K1 back with depreciation losses out there, they don't get to take the losses. In 1986, the government figured out that all these hedge fund guys were going and buying buildings and ginning up a ton of losses and paying no income tax on their income. And so they did this like major tax reform to separate passive losses from active income. So passive income, you pay tax on it. Active income, you pay tax on it. Active losses, you get as a deduction out there. Passive losses, you can only set off with passive income.
Let me try to explain this as simply as possible. And I know there's more than two types of income, but let's break it
Sure.
into two buckets. There's active income that's from my primary activity, whether it's my
Mm.
W-2 job or my number one business. And then there's secondary side hustle income, passive income from investments, from stocks, from buying things that I actually don't have any material participation in. And those cannot offset each other. So if you make $150,000 a year at your W-2 and your W-2 is not real estate and you buy a building for $1 million and you get $150,000 of deduction, that passive loss cannot offset that active income. Is that a
And
fair way
real
to say this?
estate, yes. And the IRS has gone a step further to basically say real estate income by its nature is passive. Like if you're getting paid rent on a building, that is passive income and it generates passive losses. So the only way to be able to deduct those passive losses against your ordinary income is to become a real estate pro. And to become a real estate pro, you have to meet these two thresholds. You have to spend 750 hours in real estate, and it has to be more than half your time. So there was
Mhm.
an IRS court case, there was a tax court case a couple of weeks ago where it was like a lawyer or something said he was also a real estate pro. He had a full time job, but he's also a real estate pro. And the IRS just was like, no, you can't have a full time job and be a real estate pro. It's impossible.
Mhm.
You
Mhm.
you don't work 80 hours a week. We don't believe you. So
Okay, so then there's a loophole around this, which is marriage, and you alluded to it earlier. That is, if a high W-2 income earner in small business and entrepreneurship and consulting as a doctor, whatever, marries somebody who is a real estate professional, then jointly they both qualify as real estate professionals.
that's right. So
Powerful.
that's a beautiful thing. So and yeah, that basically the other big opportunity with real estate pro is if you are, we talk about these qualifying industries, development, redevelopment, construction, reconstruction, acquisition, conversion, operation, management, leasing, brokerage, owning and renting.
Mhm. All these
Uh,
different assets that kind of bleed into the real estate industry.
so the big one is if you're in construction, you're a real estate pro. Or if
Hmm.
you're in real estate property management and you own the company you work for, you're a real estate pro. So those are huge opportunities where if you're in real estate construction, you got to be
You
doing
must
one
own
or
at
the
least
other.
5% of the company, though. So, like, if you're an acquisitions guy for a real estate shop, but you have no equity or no promote, then it's hard. It's harder to make that case.
That's tough. Yep. So
Good deal. Let's talk about recapture. Eventually, what goes up must come down, or what's the word here? Newton's
what
law.
goes down must come back up, unfortunately. So yeah, if this is great. You buy $1 million property, you get 300 grand of bonus depreciation year one, you save 100 grand of tax, and then you go buy a jet ski. And then you have a rough few years in the market and you go sell that property at, you know, break even, or you go sell it for 1.2, you crushed it, right? Well, you're going to pay taxes on that 200 grand of gain you got. You're going to pay capital gains tax 20%. So you're going to owe 40 grand. But that 100K that you got to deduct and go buy the jet skis with 3 years ago, well, the jet skis gone, right? It floated out to sea or whatever. And you still owe that 100K. So you need to be understanding that this is a timing difference. This is a deferred tax liability. You are borrowing money from the government interest free.
There's actually some situations where people have to sell buildings at distress and
Yep.
just pay the note off. They're not getting actually any cash, but their basis has been depreciated down below what they sell an asset for, and they actually have a tax bill at the
Yep.
time of closing because they took a ton of bonus depreciation at the beginning. Life was great. The deal went wrong. They had to sell the asset at a loss. Even though they sold it at a loss, it was still a taxable gain because of all the depreciation they took. I'm gonna explain this as simply as possible so people get it. Buy $1 million building, depreciate 250K. You have 750K of basis left. Sell it for 1.5. You have 750K of total tax, 500K at capital gains, 250 at recapture. That's what this is showing. So you're gonna have tax that comes back when you sell an asset. This bonus depreciation doesn't last forever, so it really matters how long you plan to hold a building. People call RE cost seg and call Mitchell all the time, say, should I do a cost seg on this building? And your first question is always, how long do you plan to hold it? If you plan to hold it for more than 3 years, it generally makes sense because you can defer a lot of taxes in 3 years and put that money to work. But if you're trying to flip this thing and sell it next year, it very rarely makes sense. Strip mall guy, Don Tepman, very rarely does cost segs because every deal he does, he's trying to buy, fix, and sell. And he sells it within 24 months. So he does not do cost segs. I think that's a shame. I think real estate is really powerful with time, but there are a lot of business models that sell quickly. If you're in one of those business models, you can make a ton of money, but this is not for you.
Yeah. And so also, I mean, there are some ways through recapture. You can 1031. Opportunity zones do really well with recapture because they get that step up in basis, at the end of 10 years. So there are some ways to mitigate recapture. Also, there's just ways to mitigate recapture in the sense of if you're walking into a bunch of recapture, we've advised some people about, effectively doing a cost seg on the way out, a purchase price allocation to make sure that you're valuing the recapture assets properly. But that's mostly for really, really big deals out there.
Big news, guys. I created a free PDF that details my method on how I analyze a self-storage facility and figure out what it's worth. Give me a pen, the back of a napkin, and a couple metrics, and I can figure out about what the property is going to be worth to me. If you want to download this PDF, click in the show notes, the first link, and you can give me your email address and you get a email right away with 4-page PDF that outlines exactly how I think about underwriting or giving my initial analysis on a self-storage facility. Again, click the link in the show notes and you're going to get that document for free. This episode of The Nick Huber Show is brought to you by RE Cost Seg. If you want to maximize your bonus depreciation and minimize your tax liability, make sure to do a cost segregation study on real estate you've recently acquired. RE Cost Seg offers the lowest priced, fully engineered studies in the business, and you get a virtual site visit with a quick turnaround. They did 30 plus cost seg studies for me over the past year, including a short-term rental, along with my self-storage facilities. And I'm also an investor in the business, along with my good friend and CPA, Mitchell Baldridge, who you all know. To learn more about how bonus depreciation works, listen to episode 75 of The Nick Huber Show, or visit recostseg.com to go ahead and get a free proposal that outlines the cost of the study and your potential savings. Thanks again, recostseg.com.